A lot of investors are looking to diversify their holdings out of the US, which has been very strong and has become quite expensive, and into other markets around the world, which are maybe better value, a bit cheaper, and have got pretty good growth prospects. So, to come back to your question, what are the three funds?
Hello, I'm Kalpana Fitzpatrick, digital editor of MoneyWeek. Welcome to another episode of MoneyWeek Talks. MoneyWeek's motto is to make it, keep it, spend it. And in each episode, we help you do just that with our top guests who come with incredible insights and views that will help you shape your finances. Whether you're looking for the latest trends, want to make sense of your finances, make more money, or just want to understand the world of investing better, then this is for you. In this episode, I have the pleasure of talking to Tom Stevenson. Tom is an investment director at Fidelity International. He's also a columnist for The Telegraph and an expert that often appears on our screens. And in fact, Tom started his career as a financial journalist and has become a go-to expert for his views on everything from what is happening in the markets, inflation, outlook to investment trends. There isn't anyone better than Tom to share top tips with when it comes to investing. He's been doing it for 30 odd years, and today I am happy that he will be sharing his insights with you to help you continue with your investing journey. Hello, Tom.
Kalpana, thanks for having me on.
Thank you for being here. It's great to have you here today. So, Tom, I know we've spoken a few times and you do have so many insights. I'm so happy that you're sharing them with us today. Every year you share your top funds to invest in. So what are your top funds for 2026?
Okay, yeah. So as you say, every year, beginning of the year, I set out some fund recommendations, and they sort of sit within the context of my outlook for the year ahead, which I've also just written. And so maybe just quickly on the context that we're sitting in, because obviously we've just come out of 3 very strong years in the stock market. So prices have risen quite a lot. And last year was as strong as the previous 2, quite unexpectedly, actually. And I think people at the beginning of last year didn't expect it to be, quite such a strong year. It really was a strong year. So coming up with fund recommendations in that context is a bit of a challenge, because, you don't want to catch the top of the market. You don't want to be recommending people buy investment funds just as the market turns. So I've given it a lot of thought and thought about the backdrop to where we are. And what happened last year was quite interesting. We saw that the US stock market, which had been really the lead, had led markets higher for many years, kind of started to fall behind a bit last year, and other markets picked up the baton, if you like, and we saw strong performances from European shares, but also from emerging market shares, and the UK market, our own market, also did pretty well last year. So that was the context in which I was thinking about which funds to recommend this year. And I think that what we saw last year is actually going to continue in the year ahead. So I think that a lot of investors are looking to diversify their holdings out of the US, which has been very strong and has become quite expensive, and into other markets around the world, which are maybe better value, a bit cheaper, and have got pretty good growth prospects. So, to come back to your question, what are the three funds? The first one is a global fund, which means that it has the ability to invest all over the world. I really like global funds because I think some of the best managers of funds invest in global funds. They have a really broad canvas in which to find their investments. So the one that I've picked is the Dodge & Cox Worldwide, that's the name of the company, Global Stock Fund. It's an unusual global fund in a way, because most global funds have a very high exposure to the US market, just because the US market is the biggest in the world. It accounts for about 70% of the value of all stock markets around the world. So if you're running a global fund, you're likely to have a lot of American shares. This one actually has a much lower exposure to the US than many global funds. Has about 50% of its assets in US shares. So I think, given what I've said about this rotation out of the US continuing this year, I think that's one of the reasons why I like that fund. And it's also got a bit of an emphasis away from the types of shares which have done really well, and those are specifically the sort of the technology stocks, the AI focused stocks, which have really driven very high valuations in the US. It actually invests in other sectors. It's got a very wide range of companies all around the world, from Taiwan to the UK to Europe, some in America, as I say. So that's the global fund. That's number one pick. Then the second pick is actually one of our funds. It's a Fidelity fund. It's called Fidelity Special Situations. It's a very long established fund. Some investors will have heard of an investor called Anthony Bolton. He was the original investor who ran that fund. It's now been passed on to one of his successors, a guy called Alex Wright, who's really kept up the good work with that fund. So why the UK? Well, the UK is a very different market from the US. The kind of sectors which the UK is well known for is sort of heavily weighted towards are not those technology stocks that we see in the US, the Alphabets and the Apples and the Nvidias, all of those. It's more in sectors like pharmaceuticals, like banking, like mining, sort of, if you like, sort of quite old economy sectors, which have actually started to do quite well. And the main attraction of the UK for me is that it's very cheap. It's relatively cheap compared to the US. So as investors, as I say, are moving out of the US and looking for other opportunities, then they're going for markets like the UK, which is really, really cheap. So I think the Fidelity Special Situations Fund is a really good way of accessing that UK market. It's got a long track record and it's done well. So that's pick number two. And then my third pick is, I mentioned emerging markets. So emerging markets are places like China, India, South America, Brazil, South Africa, places like that, developing economies. Now, over many years, they've really underperformed the American market because America has dominated stock markets. And we've seen this in the past, that you get these long periods in which either the US does well or the rest of the world does well. And we've had a really long period in which America has outperformed. And I think we're getting to a stage where that rotation is happening and emerging markets look attractive. And there are good long-term reasons to invest in emerging markets. They've got higher growth rates. They've got populations which are young and growing. And there are short-term reasons as well. And one of the things which makes emerging markets really attractive is when the US dollar falls back. That tends to be associated with good performance by emerging markets. And what we saw last year was a fall in the value of the dollar. And as interest rates come down in America, we think that the dollar is likely to continue to fall. And so we think that's a good backdrop for emerging markets. So the fund that I've picked is the Lazard Emerging Markets Fund. Again, long-established fund run by a guy called James Donald, who's a really experienced investor. He's actually based in the US, but he invests all over the emerging world. And again, very good track record there. So those are the three funds: the Dodge & Cox Worldwide Global Stock Fund, the Fidelity Special Situations Fund, and the Lazard Emerging Markets Fund.
Thank you. I feel like emerging markets are making a comeback. Definitely going to be a talking point for 2026. And some of our listeners will be at different stages of their investing journey. Some will be beginners, just want to know how to get started. Some will be close to retirement or even in retirement. And there's everyone else in between, saving for their families or their long-term goals. So there isn't always a one-size-fits-all solution. How do these three funds fit in there, or are there other funds that people should consider? So maybe if we start with, if I'm a beginner, which funds would I pick? And also, how do I go about picking a fund? Because that's quite baffling for a lot of people who are just starting out. Where do you go to pick your funds, and which types should you consider, or which ones even?
So there are lots of different questions there.
So if we start with the beginners, let's start with the beginners.
So if you're a beginner, I guess if I were talking to a beginner investor, I think two things really matter. The first thing is, if you're just starting out on your investing journey, what you really don't want to do is you don't want to lose money to start with, because that's going to put you off investing. And so I think that what I would say to people is, try and avoid losses early on in your investing career, because then you'll build your confidence and you'll want to stick with it through the cycle as you go on through your life, especially if you're a younger investor and you've got years ahead of you of investing. You want to have a good experience to start with. So what's the best way of avoiding early losses? Well, one of the best ways to do that is to have a well-diversified portfolio of investments, because at any one time, some investments are going to go up and some are going to go down. But if you're well diversified, then you should get a smoother ride with your investments. So I think, one of the ways to get that diversification is to have geographic diversification. So I mentioned the global fund, that Dodge & Cox fund. That's a really good example because it invests in Asia and Europe and America. Then, if one market does better than another. So last year, for example, the US market was up by about 10%, but emerging markets were up by about 25%. So by having a mixture of the two, you'll get a smoother ride somewhere in the middle, which I think is really helpful. So I would say, think about diversification. And then I think, think about cost as well, because if you're just setting out on your investment journey, then how much you pay for your investments, it might not sound very important. If you're paying a charge of 1% or less than that in any given year, but rolled up over the years, the cost is really important. So, one of the ways of reducing your costs is to invest in what's called a passive fund. And so maybe we just go a bit of a diversion there.
Fine, yeah.
So, passive funds are basically investment funds that just invest in all the stocks in any given index. So, like here in the UK, the FTSE 100 is the main index. In America, it's called the S&P 500. So a passive fund might just invest in all of the 500 companies in the S&P 500 or all of the 100 companies in the FTSE 100. And because that's all they do, because they just buy all the stocks in a given index, there's less work to do, there's less analysis that has to be done, so they're cheaper to run. So those funds can be a really good way in, especially for a beginner investor, keeps the cost low and gives you good exposure to the market. So I guess that's what I would suggest.
Yeah. And if anyone does want to read about passive investing, we have plenty of explainers on MoneyWeek.com. And what about people who are close to retirement? What should they be thinking about when it comes to investing? And are there any specific funds that they should pay close attention to?
I feel like you're looking at me now. So
Oh, I'm not. No,
you were very kind. You were very kind, or not, earlier on to mention the fact I've been doing this for about 30 years, which is true. So I am, I'm sort of conscious of what people are thinking about when they're approaching retirement, and it's interesting because you do think about things very differently. So one of the things that you want to do as you approach retirement is to to avoid losses, because for a different reason.
Yeah.
I mentioned that the beginner wants to avoid losses because they want to build their confidence.
Yeah.
As you're approaching retirement, you want to avoid losses because once you're retired, there's not much you can do about it. You're no longer putting money into your retirement fund. You're living off what you've accumulated. So you kind of want to reduce your risk a bit as you approach retirement. But there's a bit of a caveat here, because one of the sort of rules of thumb was that, as you approach retirement, you would reduce the exposure to stock markets because they're quite volatile and they move up and down a bit, and you'd move into what were thought to be safer assets like bonds or cash. The problem with doing that is that, we're now in the fortunate position where, we can expect or hope to live for quite a long time in retirement. And if you're going to live for 25, 30 years in retirement, then you have to be very focused on inflation in particular. Inflation can be a real killer if you're living off a fixed income, because your income doesn't rise, the cost of living does rise. And so you need to invest in a way which protects you from rising inflation. So, I would say, yes, you've got to strike a balance. You've got to try not to lose money, but you've also got to remain exposed to the assets, the investments which are going to do best. And those tend to be stock markets. So I think, the thought process as you approach retirement is similar, but also quite different from when you're starting out.
Yeah, that makes good sense. And so we've spoken quite a lot about where we're going in 2026, some of your views about that. Just going to reel back to 2025 when it was all about the AI, the Mag 7. What are your views on... in fact, let me just go back. So last year we also spoke a lot about the AI bubble, and perhaps that's made some investors nervous. What's your views on AI? Do you think there will be a bubble? And, what's the future for investing in AI going forward?
So I think AI is a really interesting topic for investors. And for me, having been around for a while, I remember quite clearly what's called the dot-com bubble, the internet bubble of about 25 years ago in stock markets, where there was a lot of excitement about the internet. People were investing in this new technology and they thought it was going to change the world. And of course, they were absolutely right. The internet did change the world, but it took a few years to do it. And actually, arguably, it took the invention of the smartphone really for the internet to fulfill its real potential. So at the time, 25 years ago, shares in that area were bid up to very expensive valuations. And ultimately, when that happens, it goes the other way and that bubble burst. So that's the kind of backdrop to when people have been over the last year, and you're right, there has been a lot of talk about whether there's a bubble in AI. I think there are some similarities. There's some echoes of 25 years ago. Yeah. There are also quite a lot of big differences. I mean, the similarities are that it's a new technology. It is going to change the world. I mean, I'm absolutely convinced that AI has enormous potential to enhance all sorts of aspects of our lives, to make companies more profitable, more productive. So I think that investors are right to be getting enthusiastic about AI. What we don't know is who the winners are going to be, what types of companies are going to win out. And often when you get a new technology, the initial beneficiaries, or what you think are going to be the beneficiaries, don't turn out to be the real winners. So it may well be that the companies that everyone associates with AI at the moment, which is the likes of NVIDIA, which makes the chips which drive all these big language models, they ultimately may not be the big winner. It may be other companies completely that learn to harness AI technology, but not necessarily to deliver the technology. And so I think that that's what's happening at the moment with investors. They're beginning to look a bit more, they're beginning to scrutinize the area and to be a bit more disciplined about saying, well, I'm not sure about that. Maybe it's something different. And that's why we're getting a bit of a rotation. But is there a bubble? I don't think there is a bubble at the moment, because for two reasons. I mean, one, I think that it's real, a bubble is really associated with something which isn't real, which is a bit artificial and pumped up, hyped up. The other thing is that the valuations of companies, although they're relatively high compared to history, they're nothing like as high as they were in previous bubbles, like the dot-com bubble. So I think that I'm not concerned about a bubble forming. It may well form in the future, but I don't think we're there yet.
Right, okay. So there's still opportunities to be had in AI and investing, but I think what I'm hearing is it's not always the companies that are shouting the loudest at the moment.
Exactly. So it's a case of thinking laterally.
Yeah, absolutely. Yeah. It's always the quiet ones, right? And so also we spoke earlier about the UK market. You alluded to the fact that it did do quite well towards the end of 2025. I feel like the UK market had quite a lot of ups and downs last year. And at some point, we had investors saying, I don't want to invest in UK equities. And then towards the end of 2025, we saw research to say people are backing UK companies. What is your feeling about the UK market going forward? Are you quite positive? Do you think there are bargains to be had?
The way I look at the UK market is, just in terms of valuations, there's a sort of simple rule of thumb valuation is that you look at the price of an investment and you compare it to the earnings that it generates. That's, in the jargon, it's called the price earnings ratio. And that's a very simple yardstick for whether a market or an individual investment is cheap or expensive. Now, in America, the average share will cost you about 23, 24 times the earnings it's generating. Historically, that's quite expensive. In the UK, you can buy the average company in the FTSE 100 or the FTSE 250, which is smaller companies below the leaders in the UK, for about 12 or 13 times their expected earnings. So, it's only about half as expensive as the US. It's cheaper than a lot of other markets around the world. So in Europe, for example, the equivalent number is about 15. In Japan, it's 15 or 16. So, I would say that, possibly the only market which is as cheap as the UK at the moment is China. And there are good reasons why both China and the UK, should be cheaper. The UK economy, as we know, is not in great shape. But an important point to make about the UK is that the UK stock market is not really a reflection of the UK economy. It's a very international stock market. It invests in companies which make a lot of their earnings overseas. So I think, you shouldn't look too closely at what's going on in the UK economy, look at unemployment or earnings growth or things like that so much as the global economy when you look at the UK. So I think the UK has advantages. It's cheap and it's global in nature. So I think this is actually a good opportunity. And I think we began to see it last year. We began to see investors really warming to the UK for that reason. And not just in stock market terms, but in terms of businesses as well. A lot of UK listed companies have actually been acquired by especially American companies. They've come over, they've seen the value, they've seen it's cheap, and they've bought the companies. And that, for me, is a good indication that the UK is cheap.
Yeah. I guess what I'm hearing a lot is people just feeling quite nervous. It's those headlines that make people nervous about the UK. Also, we see people leaving the London Stock Exchange, the companies leaving or not listing IPOs here in the UK. And I think those are the headlines that I guess make people quite nervous about the UK. But I think what you're saying, actually, if we look beyond those headlines, the UK is still quite strong and worth adding to your portfolio.
Yeah, I think so. I think as part of a sort of diversified, sort of balanced portfolio, then the UK definitely has a place, and it's largely on the basis of that valuation.
And it should certainly have a place in a portfolio.
Yeah.
What about the US? Geopolitics makes everyone nervous. We heard, again, a lot of people not wanting to invest in US equities. And in fact, we heard people just say, no, actually looking at Europe instead. What are your views on the US market?
Yeah, so we've talked about the valuation of the US market, and the US market is the most expensive market in the world.
Yeah.
And ultimately, in the long run, valuations are a good predictor of the returns that you're likely to get from a market. So the more expensive a market is, the more you have to pay to buy a share or an index in a market. The lower your likely returns are going to be on average. But in the short run, that's not necessarily the case. And we saw that, over the last 3 years. The US stock market has been expensive for a long time, but it's also performed really well. The other reason why the US has performed really well is that it's a fantastically strong economy, and the earnings growth of American companies has been really strong, and it's been stronger than in the rest of the world. So you could argue that it's justified that the UK market should be more expensive than other markets around the world. So I think the truth lies somewhere in the middle. That yes, there are good reasons why we should like the US. And I mentioned right at the beginning that it accounts for about 70% of the value of global stock markets. It would be pretty strange to be an investor with a balanced portfolio and not to have an exposure to the US. But probably, I think what we've seen over the years as the US market has grown and has outperformed other markets is that many investors have probably got more exposure to the US than maybe they should have, or maybe they want to have, or maybe even know that they have. So I think that's why we're seeing this rotation out of the US. And I think that's right. So the short answer is I would have an exposure to the US, but probably a bit less than we've got used to.
Yeah. Great, thank you. And you mentioned, we spoke earlier about if you're close to retirement or in retirement, what you need to think about when you're investing, and you did actually mention inflation. So I just wanted to flag some research that Fidelity revealed recently, saying that pensioners could run out of money in 11 years earlier than expected because of inflation. Can you talk a little bit about, how, what they need to think about, and how can they prepare for the unknown, not just inflation, but there's so many unknowns when it comes to investing, and anything could happen that could cause your finances to deflate. And you mentioned longevity as well. How can you prepare for the worst?
Yeah, inflation is a really important topic for investors. So we did some research on this, which showed that actually it's probably it's very high up on the list of worries for investors, particularly investors approaching retirement. So you mentioned that 11-year figure. So that was a bit of number crunching, which I actually did myself. And I was really surprised by the outcome of that. So essentially what I was looking at was I kind of modeled someone saving for their retirement and then retiring and moving through their retirement. And I wanted to see what the impact would be on the level of their retirement fund, their pension pot, of adjusting the inflation rate. And I was really struck and surprised by what a big impact a relatively small change in the inflation rate would have. So the Bank of England has a target of 2% inflation. It tries to get the inflation rate back to 2%, and it's largely failed to do that for quite some time. At the moment, it's running sort of between 3% and 4%. So it's not much higher. You wouldn't think, well, that's not much different, is it? But when I did this research, I did it on the basis of 3.6% inflation. And that's where I got this figure of running out of money 11 years earlier at 3.6% than if inflation had run at 2% through this period. And the reason why it has such a powerful impact is because you're talking about a small change, but over many years. So that difference is rolled up, compounded over many years. And of course, what happens when you move into retirement is that you're no longer protected from the impact of inflation by a rising earnings stream. So as you're working, hopefully, not always the case, but hopefully your salary will go up in line with inflation, or better if you get promoted. But when you retire, you don't have that benefit, but you still want to keep up with the rising cost of living. So you'll probably want to take, a little bit more each year out of your retirement pot to maintain your standard of living. And that's where the problem arises, because if you're increasing the amount that you take out, not by 2%, but by 3.6%, and you stay alive for 25, 30 years in retirement, that's when you start to have the problem. So I think people underestimate, the impact that inflation can have on your investments. And for me, I think it's the most important concern that people need to address when they think about how to manage their retirement savings. And unfortunately, there isn't really an easy answer. The simple answer is that you probably need to save more than you think. You possibly need to work a little bit longer than you think. And you probably need to get slightly better investment returns than you think. And you probably don't need to make very big differences in each of those. So, another year's work or another 1% on your investment returns, will all help. And so, I think, but many people don't really think about that. And I think they need to.
Yeah. And I guess the important message from that is, it's quite a scary thought for running out of money in retirement, because I can't remember the exact quote, but there's a quote, you can afford to be poor when you're young, but not when you're old.
Yeah.
So, and you might find that you're not in a position to work. So is it a case of doesn't matter how old you are, if you're listening, just start pumping more into your pension as soon as you can. And even a small incremental increase can make a big difference, because a lot of people, what they do is auto-enrollment is great, but then they stick to those limits as well. So if you can increase it and your employer is going to add more to it, it's always worth considering if you can.
We talk about the power of small amounts, and even just a small increase in the amount that you save. So let's say let's say your employer's putting in 5% of your salary into your income, and you're putting in another 3%, so that's 8%. If you nudge that up to 9%, by just saving a little bit more, that will make an enormous difference. And the other key thing is when you start. If you can just, start thinking about it in your mid-20s rather than your mid-30s, that extra 10 years will make an enormous amount. And you don't need to save an enormous amount. You just need to get started. You need to get going and get the habit of saving. And you will thank yourself in 30 years' time. You'll look back and you'll say, I am really glad I did that.
Such a hard argument to have with someone in their 20s.
Because you've got loads of other things to spend your money on. And then, and then you get to your 30s and maybe you've got children, you're, looking to buy a house. There's always something. There's always another call on your money. I'm not pretending that it's easy, but it's really important if you can to think about it.
It's always easy to let go of the pension savings, but it's, as you're saying, it's worth doing, and a power compounding over those extra 10 years or so can make such a big difference. Yeah. And so worth thinking about. Thank you for sharing that. And another thing that I wanted to talk about is the 4% pension rule. Now, we've written about this a lot, but I know you have as well. Can you talk to me a little bit about the 4% pension rule? What is it, and how does it work, basically?
So the 4% rule is another rule of thumb. We're in our business, we have lots of these sort of rules of thumb. The 4% rule is designed to answer the question, how much can I safely take out of my pension pot? And the reason why things have got more difficult for people saving for a pension now compared to years ago is, in the old days, people used to receive what were called final salary pensions. So they would stop work, and their employer would pay them, effectively carry on paying them a salary for the rest of their lives. They didn't need to think about the investment returns, and they certainly didn't need to think about how long they were going to live. Unfortunately, we've moved away from that system of paying for pensions towards a system which is called not final salary, but defined contribution, which basically means you put money into a pot, you build it up over time in the markets, then you retire, you have a pot of money, and you have to live off that pot. There are two variables there. You don't know what the returns you're going to get on that throughout your saving for retirement, but also the returns you get when you're in retirement. That's the first variable. The second really important variable is you don't know how long you're going to live for. And so it makes it really difficult to know how much you can safely take out of your pension pot and still not run out of money. We talked about running out of money earlier on. So this 4% rule was it was devised by an American financial advisor, a guy called William Bengen, who my colleague Richard Evans actually interviewed and has written some really interesting articles actually on our website. If I can give a plug for our website, fidelity.co.uk. Markets and Insights is the name of the section. Richard has spoken to William Bengen about his 4% rule and some really interesting articles. But essentially, what the rule says is that if you take 4% of the value of your pension pot at the start of retirement, increase it by inflation every year, then you... And he back-tested this all the way back to the 1920s through all sorts of markets, through market crashes, through inflationary periods. So he really, did everything he could to future-proof this rule. And he worked out that if you only took 4%, then you would, pretty much guaranteed, there are no guarantees, unfortunately, but you could be as certain as you could be that your money would last for another 30 years in retirement. Now, he subsequently actually revised that and said, actually, I think maybe I was a little bit cautious with that 4%, and maybe a bit more than that, maybe 4.6, 4.7% might be safe. But it's just a rule of thumb. It basically, it says that, for every £100 of savings that you've got, you can afford to take £4 a year safely, and you're not going to run out of money.
Great. Interesting. And it's always good to have a rule of thumb, not to run out of money. And that's what investing is all about, right? I mean, retirement is a long-term goal. So if you're listening and you're thinking, well, I'm a long way away from that, it's still a long-term goal, and that's what investing takes you towards. So I mentioned earlier, and I think you're kind of slightly letting me off that you've been doing this for 30 odd years. What would you say are some of the biggest lessons you've learned when it comes to investing, and what are you taking into 2026 and beyond?
I think the biggest thing that I've learned is that the first thing I've learned is that it's not easy. So it's very difficult, when ahead of time, you don't know what's around the corner. We don't have a crystal ball. And in order to mitigate against that lack of foresight that we have, a few things I've learned. One is to make sure that I'm really well diversified. We simply don't know which markets are going to do well, which markets are going to do badly, which individual shares are going to do well and badly. And the best way of protecting yourself against that is to have your eggs in lots of different baskets, to be well diversified. The second thing I've learned is that it's very difficult to predict when things are going to happen, when the market's going to go up, when it's going to change direction and go down. Trying to time the market is very difficult, almost impossible. And the best thing really is to just stay invested, to keep putting money into the market, drip money into the market over time, and don't try and second guess what's going to happen and when it's going to happen. So I think, the main lesson I've learned, it actually is a bit of humility, really, is that, we don't know what the future holds. And so we just need to hope for the best and prepare for the worst.
Yeah, absolutely. And you've mentioned diversification quite a few times, so it's clearly really important.
It's fundamentally important.
It is fundamentally important. And well, thank you so much for sharing your insights. And I always like to ask a few fun questions towards the end. So, ready?
Yeah, I'm ready.
Good. And so if I was to give you £5,000 today, what would you do with it?
So that is a very difficult question to answer, because are you saying what would I do with it?
What would you do with it, you personally?
I'd go and have a holiday, but that's because because I'm approaching retirement, and I've already put in place my pension pot. Now, if I was 25 years old, I might answer that question very differently.
What would you do with it as you're 25 years old?
Well,
just out of curiosity.
Yeah, I would still have a very small holiday for some of it, but I would invest.
I feel like you just want to get away, Tom. What advice would you give yourself as a young adult?
Get started. Do it.
Just get started with investing.
Yeah.
It's such a good message, that, because It's just one of those. Just do it.
Just do it, because you don't need to put aside, 25% of your salary. Just put apart a little bit. It's all about getting into good habits. So just get started. Just do it.
Yeah, like that. And finally, if you could make something into a petty law, what would it be? Something petty into law is what I mean. What would it be?
Oh, something petty.
But Tom's going to make it into a law.
Right.
I like to catch people out.
You've completely caught me out. Does it have to be anything to do with nothing to do with investment?
Money. I mean, if you want, unless you want it to be, it could be anything. It must be something that really irritates you.
Okay. What I would do is I would ban people listening to music on their phones on public transport. That's why you have headphones.
Yeah, I like that. I'll tell you a secret. Almost every guest says that. It must really irritate people. So I think this really should become law.
Yeah, it is so annoying and so antisocial and so unnecessary.
Yeah.
Everyone's got headphones. Just use them.
And it's fair. It's only fair. Thank you, Tom. It's been a pleasure talking to you today.
Thank you so much for having me.
Thank you for sharing your insights and your wisdom with us. Thank you.
Thanks.